What's up, gold miners? Today we welcome Zihao Wang to the show. Zihao is the CEO and founder of Motiva Holdings, a real estate private equity firm focusing on acquiring and operating multifamily investments. Motiva Holdings is a family business and currently holds over $500 million worth of real estate assets. As his family built and grew this portfolio, Zihao was a part of the growth, the management, and the oversight of the portfolio from a very young age, having started managing and overseeing these properties as an early teenager. So needless to say, real estate runs in his blood, and he brings an incredibly fresh perspective to this program. We start off the episode with Zihao giving a detailed overview of how they grew the portfolio from soup to nuts, and also goes over when they hit certain milestones, like when they decided to vertically integrate and bring property management in-house. Later on in the episode, we discuss the California market and why his family loves investing there despite the obvious headwinds. And finally, we conclude the episode by discussing the current market volatility that we've experienced, his outlook for 2025, and how him and his family are preparing to take advantage of what this upcoming market has to offer. This episode is filled with knowledge and wisdom from an incredibly experienced owner and operator. So without further ado, everyone, let's welcome to the show, Zihao Wang.
The Gould Mine Podcast.
Zihao, welcome to the Gold Mine.
Thank you so much for having me.
Yeah, man, this is exciting. I'm really looking forward to this conversation. You've been in real estate for quite some time, and it sounds like you were brought into real estate, like you had some family connections in real estate. Is that correct?
Yeah. So, I mean, my parents made their first money in the fashion industry, so not related to real estate. But in the early 2000s, they set up the family office and started investing into real estate locally in Southern California. So I was still quite young back then, so it was kind of brought together up, with my parents, kind of learned everything ground up.
That's amazing. So family started in fashion, then got into real estate. Just out of curiosity, right? Because you see a lot of people, young people, right? And you look quite young. I'm not sure how old you are. I don't know if I have that in my notes, but that's not really relevant to this conversation. A lot of people, they have family, the family has success. You see the young kids kind of like go off, they do their own thing. They just spend a lot of money and don't spend any time kind of like growing the family business. So what do you think it was that kind of like inspired you to kind of grow the family office and like grow that legacy as opposed to just like wasting it?
Well, I think, from a young age, I was always really close to my mom. And so kind of being super close with her, she would take me to properties. We would do property tours together. We would do like site visits together. So it was kind of like an upbringing that was very natural to me, right? I think a lot of what you're describing is when kids just go to school and then go to college, and then there's really no involvement into the family business. And then all of a sudden it's like when they're 25, 30 years old, their parents are like, okay, now I want you to come back into the family business and do X, Y, and Z with the family. And for somebody like 30 years old, it's really hard to like give up everything that they built for the first 30 years of their life to do something completely different, right? Whereas for me, I was brought up at like 13, 14 years old into the real estate industry. Right. So we did a lot of things together with my mom. We kind of set up our own property management team together as well. We built our team together. We did multiple acquisitions and full cycles together. And so it was much more natural of a transition for me than it might be for some others who didn't have that kind of closeness or relationship with their parents at such a young age.
I think that's a really fresh perspective, man. It's interesting because, there can be a sense of entitlement, but what you're saying is that like the sense of entitlement is kind of eliminated if you are exposed to the work that it takes to build at a young age. So you were exposed to that work ethic. You were exposed to the behind the scenes way before your formative years is what it sounds like to me.
Yeah, it's like exposure to the work ethic, but also exposure to the space, right? So like, for example, most people, when I was in college, most people just find an internship and then find a job, and it's not really related to the family, right? But where I came from, I knew I was kind of growing up in a real estate, and I kind of wanted to do real estate. So actually the path of least resistance is real estate. And so it was a much more natural transition because of how I was brought into it than many others.
Yeah, that makes a lot of sense. So Walk me through that journey, right? So your family obviously had some money. They started parking it into multifamily assets. Is that correct?
Yeah.
Okay, cool. So now you're 34 multifamily properties deep. Is that correct?
Yeah.
So what does it take to scale a portfolio? Like, what does it take to scale to a portfolio of 34 properties? Like, walk me through that journey, because it sounds like you've been involved in a lot of that, a lot of that growth. So walk me through that growth process.
It starts slow. Our family's personality is more like trying to never strike out, right? So it always starts slow in the sense that we want to know everything, kind of the nitty gritties of operations within an asset. So we kind of started slow by getting one asset and then running that entire operations ourselves, learning everything there is to property management, construction management, etc. And so from there, we began to feel much more comfortable into scaling after we learned kind of the nitty gritties of each individual step in operations. And then also, so that's one. It always starts a little bit slow and getting used to that pattern of buying real estate. And then the other thing is about timing, right? So I think we did quite a few acquisitions kind of in the 16 to 18 years, like 2016 to 2018 years. That's when we felt like, we were comfortable in operations. That's when we kind of built our team out already. So we felt it was time to scale up. So actually most of our stuff, we bought in the 16 to 18 years and then kind of sold some of the stuff in the 20 to 21 years. And then others we just kind of held.
So when you're selling them, right? Because obviously, like, I'm assuming you didn't just sell them and sit on the cash, right? You're selling them and exchanging into something bigger, correct? So
usually, yeah.
Okay. So walk me through that, right? Because you're selling them at a time where everything's appreciating really quickly, right? And then it sounds like you exchange into a bunch of properties. How has that portfolio managed, or how have you managed the portfolio since the rates kind of took, went sky high? Were you locked into stuff that was more fixed rate? Was it variable, like, or what did that look like?
Yeah, so it depends on the loan, right? So for some value add stuff, we just do fixed rate debt. We try to limit our risk to having like 65% loan to value. So those are like totally fine because of how, like, when we got into it and the amount of leverage that we put onto it. And then there are some others that we put construction debt onto it. Then that's obviously floating against prime, and prime kind of shot up when rates kind of went up. But one benefit that I would say we have as a family office is we have patient capital, right? So we don't have to sell within 3 years. We don't have to sell within 2 years. We can hold on to a property for much longer than most other syndicators in the world, or even, some funds that just have to close. And so because of that, we're much longer term, and we're much more comfortable, I guess, when the rates went up than most other people were.
It's interesting. So so you're saying for most value adds, you got fixed rate debt. It's interesting because, like, a lot of value adds, they go for the bridge loan, right? Like a lot of value add properties, it's like that's the only way actually that they can even acquire the property. So what's the secret to getting fixed rate debt on a value add asset? Is it just less leverage, or what's the secret there?
It's typically less leverage. We cap ourselves at around 65% on a 120 DSCR. Fannie Freddie is like 125 probably. We're more comfortable with putting in more equity because we have the ability to do so as a family office. We don't go out and like syndicate from like 50K checks where it's like we try to push leverage like 85% and then try to lower the equity as much as possible. So it's a different kind of mentality when going into a deal, which results in the lower leverage and the ability to get fixed rate debt for even those value add deals.
Interesting. So walk me through your acquisitions process, right? So as a family office, obviously you are, I'm assuming, the primary check writer, but you're also seeking outside investors, correct? So are you partnering with other family offices? Are you going to retail investors? Walk me through your fundraising strategies and what the typical check size looks like, et cetera?
Yeah, so it's typically from other family offices or, fund managers or super high net worth individuals, like ultra high net worth individuals. So we don't raise from like the doctors or the engineers who write 50 to 100K checks. Our minimum, we don't really have a minimum, but we've kind of taken checks above 500K to $5 million. So it's really either a fund manager pooling together those retail investors and then putting into our deal, or like a family office who's able to just write a much bigger check on an asset that they believe in.
Yeah. Okay. Gotcha. And what would you say that the primary strategies are that you've deployed to create relationships with those individuals? Are you just going to networking events? Is there like a super secret wealthy club that like no one gets access to, like unless you show you have the secret handshake or whatever? Or like how are you finding access, or how are you getting access to these people?
We do a lot of networking events, but like those are kind of open to everybody. It's like NMHC, IMNs, iGlobal forums, pretty big ones. We also, as a family office, we're part of a lot of different groups as well, like Tiger 21, YPO, stuff like that. So those are a little bit higher caliber, but we really don't try to solicit in those, events. It's more about making friends and kind of learning about other families, how they made their money, etc. And over time, those relationships, merge into partnerships. And that's kind of how we've been able to do a lot of our deals. We're typically the anchor checks on basically all of these deals. So given our skin in the game, it's it makes other partners feel a lot more comfortable as well.
You're based out of California, and the majority of your assets, I'm assuming, are in California?
Yeah, around 2/3.
Okay. So what kind of resistance have you met from investors just in terms of like holding commercial real estate or holding any real estate really in California because of all the laws? You've got a lot of tenant laws that are working against you. And I'm assuming that you're buying these in metros where the laws are even less landlord friendly, right? So what kind of resistance have you met from outside investors and even internally, right? Like what kind of resistance have you felt internally just from maybe your business partners and or just the tenants themselves, just sort of like seeing, okay, well, is this the right strategy for us? Is this the right location for us? So what resistance have you met internally and externally? Yeah.
So, well, for one, like when we pick our locations, we're very picky. So we don't do much in core LA unless it's a vacant building. Core LA, it's just a lot of headwinds against it in terms of rent control, but also mansion tax. So we more focus on like the Orange County and also the other suburbs of like LA County, like Downey, Glendale. Those are more like at the state level rent control. So not as strict as, core LA or kind of what Pasadena turned into after COVID. So we pick our location depending on the laws as well. And I mean, in terms of kind of resistance internally and externally, it's kind of the same. We've felt that, we have to be wary of rent control laws. Prop 33 was on the ballot in November, or earlier in November, but it was struck down. So yeah, we're definitely aware and cautious of all these laws. And that's typically the biggest resistance, to what I'm seeing in both internally and externally. But I try to, push towards a strategy where it's like, if we believe that Prop 33 will pass and that we're still at the state level, rent control, a lot of our properties are actually going to do okay because we can actually increase rents between 8 to 10% every single year, just at the state level. And, if you get a property where an owner hasn't raised rents for 20, 30 years, you're nowhere near market rents. And if you can get it at somewhere like at a 5.5 cap, and then you do your 8 to 10% rent increases every year, you can push to a 7, and then you can exit at a 5.5 cap again in like 3 to 5 years. And that's one of the strategies we've been deploying. Our most recent acquisition was a $20 million deal in Downey. So that one was, state level rent control, which is 5% plus CPI. So around 8.9% this year. And so the strategy is very simple in that there's around a $500 loss to lease on all of the units because the owner hasn't raised rents for a long time. And so we just go in every year, hit them with the 8% or whatever percent that will be that year, depending on inflation. And as we model that increase, we really don't have to do anything. It's like you just rent increase them. If they move out, then we go straight to market, which is more than just the 8%. And so by doing that strategy, we're buying at a 5.5 cap, pushing to a low 7 cap, and then with 7, you return on cost of probably like a 7.5 to 8 cap, and then exiting back at a 5.5 cap.
Yeah, that makes. I mean, it makes a lot of sense. I would say that like my only concern, and by the way, I live in California too, right? So my only concern is that like the lawmakers here just kind of decide when they want to just completely change the rules, and they just kind of do what they want to do, right? Like San Francisco is a great example. I mean, it's obviously there's things need to be passed and whatnot, right? But with as liberal as the state has become, it seems like everywhere in California will eventually be like Los Angeles and San Francisco, right? So it's hard to see a world in which properties are protected. Rent control is not like super regulated by the government locally, right? And not just state level. So what are the safety measures that you've put in place if and when that is the case, right? Like you just liquidate the whole portfolio. Like walk me through some of the countermeasures or some of the thought process, some of the things that you've thought through in order to kind of like mitigate some of those potential risks.
Well, I mean, I think the best way to change the mentality to be comfortable with rent control is just be comfortable holding for a longer period of time. Because if you're trying to time the market with a 3 to 5 year hold, then rent control can really hurt you if it gets passed in a city, right? But if that happens and you have patient capital where you're like, okay, I can hold this asset for 20 years, then rent control is much less important since you're more depending on like just time and time appreciation. So you can definitely change the hold period of kind of your expectations there. Another thing is kind of in terms of, eviction wise, we screen our tenants very, very carefully, to make sure that the new tenants that we bring in are good tenants and can actually pay their rent on time. And so this eliminates kind of the eviction risk that we were talking about. The legislation risk is, something that you kind of have to get comfortable with playing in this state. You try to be on top of the legislations. You try to kind of know what the city council is thinking, know kind of what that board is thinking, and just understand kind of what kind of headwinds might come your way in terms of new legislation. But it's something that, you have to kind of be comfortable with. And the mitigant to that is really to try to elongate your hold, like be comfortable with elongating your hold period if that point comes necessary.
Yeah. And I mean, in terms of conserving, in terms of the thought process of like not striking out, right? I think that's a perfectly like a reasonable answer. The only thing that pops in my head is like, okay, well, like there go your cash flows. Right. There go the returns, right? Because your returns are now impacted by the state laws or by the local laws, right? So I mean, that would be my only kind of like retort to that, right? Because obviously, like from what it sounds like to me is like, hey, at least we're not going to lose the property, right? Which fair, like that's probably like the most important thing. But then like the secondary thing is like, okay, well, how are we going to hit the projections, that we've laid out for our investors?
It's still possible if you really think about it, because if you put like in the worst case scenario, right? You think, I have to hold this property for 20 years, right? The chances that a tenant will stay in one property for like over 20 years is still quite low, right? You still get the turnover over time. And as that happens, you can capture all that market rent, right? So even if like, rent control at 3%, but like market's rent is like growing at like 30% every single year. Let's just say for fun, right? Sure. As that happens, if that tenant like in the next 5 years or 10 years moves out, then I can still capture all the kind of appreciation in the rents that I missed out on in the previous years. And by just going to market, right? And in terms of cash flow, I mean, California is not really the right state for cash flow anyways. Most of the cap rates are 100 to 200 basis points lower than Texas or Oklahoma or some of the secondary and tertiary markets. So, we're more, driven on appreciation, right? It's not really kind of, okay, how much per month in cash flow can I get? Because you're probably not going to get that many, even if you you buy the perfect asset here.
Yeah, makes a lot of sense. All right, so flipping over to the business plan that you typically execute, before you're discussing like, all right, we got in at a 5.5 cap. It was, almost all the units were way below market. We pushed the rents up, got it to a 7, and then exited again in a 5.5. So to me, that sounds more of like an operational / management overhaul as opposed to like fixing up the property. So are you typically doing more management overhauls or repositionings, or is it like a value add in terms of like a cosmetic repositioning, or is it sometimes both? Like walk me through kind of like what the typical game plan is. Do you stick to just one strategy, or do you play in multiple arenas?
Well, strategy should be really dependent on the asset, but like ideal case, it should be both, right? So like if there's a long-term owner who's owned the asset for 20 years and he's kind of neglected on the rent, chances are he's kind of neglected on the property as well in terms of the interior renovations, right? So you'll probably see, old carpet, really dated cabinets, really dated countertops, horrible looking bathrooms, horrible looking kitchens. So that's probably what you're going to see. So, in terms of that, we're definitely going to upgrade the asset, right? In that case, by doing like cosmetic turns or like fixing pipes, etc. And on the operational side, if the previous owner neglected the property completely, then most likely management is not that great. Management is probably third party, and third party doesn't really align with the landlord because they get they don't really want to do work. Their margins are small anyways, right? So, for us, we're bringing in our own in-house property management team. So we definitely want to improve the operations there, cut expenses to increase NOI. And at the same time, we also do unit turns to try to pop the rents, right? It's like, the rents are $500 below market for a reason, right? It's probably because the units are way dated. So we'll definitely go in, change the kitchens, change the cabinets, change the flooring, and then try to get a higher pop.
When you're doing, have you done any ground up stuff, or is it all existing properties?
We've done 4 ground up projects. One of them was, we've led on 1 ground up project and was kind of investors in 3 others.
Okay. Got it. So I'm trying to think where I want to take this next, because there's so many, there's so many things running through my mind right now, Zihao. I'm like, I could take this a million different directions. Talk to me about the vertical integration. At what point did you assume the management of these assets as well? Was it right away? Were you property managers from day one? Did you outsource? At one point, did you tip the scales, or did the scales tip to the point where you decided to kind of take on the management of the properties as well?
We started with third party. Because it's very hard to run a property management team with very few assets. You need a little bit of scale in order to get that to take off. So we started with third party, but with a small third party, right? It's where we don't work with like the Gray Stars or the Avalon Bays in terms of property management. So we started with a local shop, very small, kind of husband and wife kind of scenario. And they were managing our assets well. But as we kind of scaled up into the hundreds of units, we felt that it was better to take over, the management in-house. And we were actually able to, through the property management fees, able to hire some people and be able to manage things better. And so what ended up happening is as we reached that scale, we began to take over the assets ourselves and bring it in-house. And that's when we really began to, be vertically integrated.
Do you know like roughly how many doors that was at when you decided to do that?
Probably 500 to 600.
Yeah. Okay. That seems to be the sweet spot for like most investors, is like, hey, once we get to about 500 is where you see a lot of people start to bring the property. It's like from 0 to like 15, they do it all themselves. And then from like 15 to 500, it's like third party. And then after 500, it's like, all right, we're going to bring it back because now we're losing too much money. Right. So
yeah,
it's pretty
it's really the ability to hire people, right? If your property management fees, like the 3 to 4% can get you, like, you have enough units such that you can hire somebody on your own team to do the management, then it's better to bring it in-house. But if you can't do that, then you obviously don't want to come out of pocket just for better management and have the pressure of, scaling up as much as possible. So it's really just a calculation of, okay, how big is my portfolio? How much rents am I bringing in? How much property management fees am I bringing in? And whether I can afford to hire somebody full time.
So walk me through the SOP creation, right? Because like I'm thinking about this as like just building, the property management company is a business, right? And so did you bring someone in that already had property management experience? Did you kind of rip off and duplicate what the current property management company was doing and just kind of add your own, bells and whistles to it? How did you go about kind of creating SOPs from scratch, to make sure that you weren't kind of like, I guess, getting into a position where you assumed the management, but like you took a step backwards, right? Because you wanted to keep moving forward. So how did that transition occur, and how did you ensure that you had the right procedures in place?
To start, we were super active with the third party property management team. We weren't just like laying back and letting them handle everything. So a lot of times, when we do repairs, we would sometimes do it ourselves, have our own kind of repairs and maintenance guy or just contractor kind of do it with us. And so by being super active and super involved in the entire operation process, we learned a lot, right? So we didn't like take back all the properties and have no idea how to do anything and no idea what Appfolio is, no idea any of that. So we were very, hands on board before the takeover. And then kind of after the takeover, we did bring on one person who had property management experience, but very little property management experience. So it's more of a collaboration between me and him, right? It's like, okay, so I've seen kind of what's going on. I know kind of how to manage properties as well. And he also had some experience. So we then bounced ideas off of each other. And so that's kind of how that grew. So we started with basically a property manager and a leasing person. And so that helped us kind of, be able to navigate the leasing and the money coming in, and also be able to control kind of the expense side of things with the property manager. So it's kind of like it's really hard to say. It's like exactly at what point in time we did what. It's more of a natural progression that started with us being super active with the third party management, and then that morphed into setting up our own team.
That makes sense. So what it sounds like to me is you really took the time. What I'm gathering, Zihao, is like you took the time up front to study what the management company was, as opposed to just saying like, hey, I'm going to be like hands off, like good luck, right? Like, thanks for taking this off my plate. You instead, allowed them to take the wheel, but you were sitting in the passenger seat, observing their every move, so that one day you could kind of assume those roles of responsibilities and skill transfer, which makes a lot of sense to me. And I think that anyone who's listening to this that eventually wants to, that's, growing or scaling their portfolio, I think there's something that you can take away from Zihao's experience. Awesome. Well, listen, I want to shift gears here a little bit. And one of the things that I keep thinking about, especially as we head into 2025, is how volatile the market has been over the last couple of years. First of all, what investment have you sat on the sidelines the last couple of years? Have you still been active? Gonna like walk me through what these last couple of years of like market volatility have meant in terms of your acquisition strategy and approach?
We were very quiet in the 2022, end of 2021, because we felt it was too scary when the rates just kind of kind of did what it did. The volatility of the market was just too scary for us. We feel real estate is more of a long-term strategy and like a more of a safer asset. So we don't want to be taking on like kind of almost equity-like risk to do this kind of stuff. So that's why we sat on the sidelines for a few years. 2024, we did a few stuff. We bought 4 properties in 2024. Totaling around 150 units, total 160 units, maybe. So we did some stuff in 2024 and end of 2023 to 2024. And we're trying to be aggressive again, kind of in 2025. We feel like right now having cash is really important. And a lot of deals that have, I guess, timed the market wrong in the height of the kind of pandemic stuff. They're going to have to go into refinances or they have to sell. And so at that point, having cash is really important. And we feel like we're well positioned to execute fast and close deals. So we want to be aggressive in 2025. We want to be aggressive in 2026 as well. And right now, one of our, strategies is to try to also diversify into other states. For example, we're looking heavily into Dallas and Houston. Those areas are high growth markets, and obviously easier on the regulations as we were talking about before. But those areas were also the places where a lot of syndicators bought a lot at probably the wrong times in 2021 and 2022. So we feel like if we're well positioned with a lot of cash going into 2025, we can potentially get a lot of good deals out of it.
It's interesting because a lot of commercial real estate guys that I've talked to, I'm in the hotel space. I don't know if we connected about that offline, but a year and a half ago, almost 2 years ago now, I was at conferences where, the guys were like, hey, it's coming, right? It's coming. Like the blood is going to be on the streets. And here we are, like almost 2 years later. It still feels like we haven't quite got there yet. And who knows with this new election, how things are going to shake up. But to me, it feels like that day is coming very soon still. I don't think that we're going to get bailed out. How are you feeling about everything that's it sounds like you still think that there's going to be opportunity out there the next couple of years, but how painful do you think it's going to get?
I'm hoping it gets very painful because I want to be on the acquisition side for that, to be honest. As to exactly how painful, we're not sure. Bridge debt has been going down because the federal funds rate has been going down. Long-term rates have been increasing because the 10-year has been increasing. And so, as it depends on the asset as to how painful it will be. If they're so on bridge, they might get, a little bit of relief on the pressure as Fed funds go down. But if they're on a pretty high, like long-term, maybe it's like still stuck. Depends on how well absorption happens in Texas, for example. If we see, rent growth climbing back, lenders may be more inclined to extend their loans a little bit more with, kind of the light at the end of the tunnel kind of mentality, knowing that, maybe if rent growth comes back, they can, still survive. Or some lenders might just be like, okay, that's it. I want my loan back, or, you've been way too delinquent, we're going into foreclosure. So it really depends on, the macroeconomic factors of kind of inflation and how rates change. And then also just on the mentality of the lenders, like some lenders are more forceful, other lenders are less. So it depends on many factors. But I'm always on the lookout for a lot of distress. So
a friend of mine said that we are in the delay and pray portion of the cycle. Right. It's like the banks just keep saying like, yeah, you can have another 6 months. No problem. Right. And then 6 months later still hasn't. Right. So I feel like that can only go on for so long. Right.
Yeah.
Right. I don't know. It's like one of those things where everyone I talk to, everyone's just kind of like, yeah, like it can't last forever. Right. And then here we are 2 years later, and it's like, kind of feels like it's starting to feel like forever, even though 2 years is really not that long, but it does feel like everyone understands, just like everyone sees the numbers, right? Everyone knows what the delinquencies look like. Everyone knows, what the special servicing rates look like. So it's not a secret. The question is, when is all of that going to hit the fan? And it hasn't quite, it's kind of like trickled on, right? I'm sure you've seen how like some good properties, some good opportunities come up in like the last year or so, right? So I'm sure you've seen it, but it hasn't like hit, right? It's not like this like wave of foreclosures. It's not like this wave of opportunities coming on the market that are at like 70 cents on the dollar.
Yeah. It's, the wave hasn't come. If you look hard enough, you might be able to find one or two like good opportunities. But for the most part, on what I'm seeing in the market is that seller expectations are still quite elevated in terms of what they think their property is worth. And it's in a sense understandable because there hasn't been that many transactions in the past 2 years. So because of that, they are looking to sales comps at the peak of the market. And so they don't really adjust to that, market completely changed in the last 2 years. It's not the same market as when interest rates were zero, right? So seller expectations, I would say, is still up there. If they're able to come down 10%, we probably see a lot more transaction volume.
Sure.
So it's really, you know, a factor of seller expectations, but also just kind of how long certain sellers can stay with their loans and how long that property really belongs to them.
Yeah, it's interesting, man. This is going to be a fascinating couple of years, and you know, it seems like you guys are very well positioned to take advantage of opportunities as they arise. Which leads me to, you know, if people want to kind of, do you have an investor list? Like, how can people find you? All of that will be in the show notes, by the way. So how can individuals reach out and learn more about the deals that you're working on?
Yes, I'm super active on LinkedIn. So you can find me on LinkedIn. Also my website, I'm actually redoing my website. So in a few weeks, you'll probably see a new one. But
Nice.
Same domain name, www.motivaholdings.com.
Sweet. Love it. Love it. So last couple of questions here for you, because we're running up on time and want to be respectful of it. But, you know, I'm always curious when I talk to someone that has, you know, an ultra high net worth family, of all the things that you guys could have done with your money, why real estate? You know, did you ever have that conversation with your parents? Like, why, like, of all, because there are lots of things. You built a successful, sounds like they built a successful business, right? So why not invest in other businesses? Why go the real estate route? What was the main driver, the main catalyst there?
So we do diversify into other asset classes, right? So we do some ventures, we do some private equity, hedge funds, public equities market. So we do have a portfolio of diversification. We really like real estate because we can be the most hands-on in real estate, right? So if you invest in private equity or venture capital, you're really betting on somebody else, right? You're betting on a founder in venture capital. You're betting on the management team in private equity. Even if you do direct, you're still betting on others. Whereas in real estate, you're betting on yourself, right? You're thinking the asset is what it is today. I'm the one managing it. I'm the one doing everything. I'm the one putting the capital stack together. So if this asset fails, it's on me. If this asset's successful, it's kind of because of me as well, right? And so I want to be able to kind of, if an asset goes bad, I want to be able to write down a list of reasons of what I did wrong, that made this asset turn bad, right? So that's one of the factors that drew us to real estate because of how hands-on we can be. In some of kind of the venture stuff, if you really dial down to it, you can say, you know, the idea wasn't good, the team wasn't good, the market wasn't good, X, Y, and Z, but you can't get nitty gritty into the details of exactly why your investment went wrong, right? So real estate, we felt we can be the most hands-on. We can figure out why things went wrong, how we can learn from it. And that's why kind of we love real estate, and that's how it kind of turned into our biggest allocation.
Yeah. So and by the way, I love that explanation. I mean, I think that like that makes a ton of sense to me. You know, I've been in real estate my whole life too, and it really is. I mean, to me, it feels like the best way to grow your wealth. And in fact, like almost every, you know, if you talk to anyone who's not biased, right, like not a financial advisor who like makes money when you invest in the stock market, right, but like someone that actually knows what they're doing. When it comes to like giving financial advice, not financial advisors, but people that give sound financial advice, it's always real estate. You know, real estate is always the foundation of a wealthy person's portfolio. That being said, though, there are a significant amount of families like yours that choose to invest into real estate like more passively. Right. So they'll cut checks rather into deals like yours. Right. And they'll take an LP position. So they don't really have that hands-on, you know, approach, or they don't really take that hands-on approach. And so why is it that you think those individuals, right, like those families that you network with, that are a part of your ecosystem, why have they chosen real estate as the foundation of their portfolios as well?
There are other reasons like tax advantages, you know, the ability to do depreciation, like through cost segregation and just the depreciation of the asset. And so there are other benefits outside of, you know, having the ability to be hands-on. If you can 1031, you can defer your taxes over and over and over and over and over and pretty much never pay, you know, capital gains tax at the federal level. And if you do depreciation, you know, via cost segregation, you're not really paying taxes because you keep on getting losses, right? And it just carries over and over and over. So there are these other reasons why people choose real estate. And I'm sure those are like big consideration factors for other families.
Yeah, I mean, I definitely see what you're saying there, and even with a lot of the other investments that you discussed before, like public markets, or you mentioned VC, you mentioned private equity, like a lot of like depending on the way the deal is structured, right? Like real estate is one of the asset classes, one of the only asset classes that has the ability, I should say, to provide you with consistent cash flow, right? And I think that's another part of it too. But that's interesting. It's a really interesting take, and yeah, I mean the tax advantages are huge, right? Especially like it seems it doesn't scale linearly, right? It's like the bigger the asset, like the bigger you get, the tax advantages compound, right? They grow exponentially. So there's a lot there as well. Zihao, this has been awesome, man. It's been a pleasure having you on. I honestly, man, I'm hoping that I can have you on again, see how you guys are, doing in about a year or so, and continue to monitor what's happening in California. I think, look, I love California, man. It's a great state. I believe in it, and I want this area. I want California to keep growing. If the politicians could just get out of the way, and leave us alone. No, I'm just messing, but really, this has been great. And in traditional Gouldman fashion, would love for you to leave the audience, see how, with one final gold nugget. Take it away.
I mean, I would say it's in the next year. Be ready to be aggressive on the acquisition side. Make sure you have your operations all lined up, and I think hopefully transaction volumes will increase, and there will be a lot of opportunities in the next year and two.
Yeah, I love that, and of course, like you're thinking of it as like an operator, and I think for anyone that is considering investing into any passive any opportunities as a passive like LP, the same principle still applies, right? Like if you've got cash, like sit on it and be ready to act, because I think right now, Zihao, and I'm sure that you could probably speak to this too, is like this market, because of the weirdness of the market, we're seeing a lot of cash on the sidelines, right? We're seeing a lot of people just like not take action, but oftentimes it's not like the risk, right? It's not like the biggest risk isn't like getting into a bad deal. Well, I mean, that could be a big risk, right? But like, I think the bigger risk is just like lack of action altogether, right? And just keeping the money on the sidelines. So you can only wait for so long, right? Before it's just like, hey, you got to make a decision, right?
Yeah.
You have to make a decision. You can't just like sit there forever and like not do anything. Sounds like you guys in 22, you took some time to kind of regroup and monitor, right? But eventually you guys took action again, and it sounds like you guys are winning because of it.
Yeah, for sure.
Love it, man. Cool. Well, this was fun. Thanks for hopping on, man.
Thank you so much for having me.
Sweet.